Hey, good day, everybody. This is Dennis Wilbur, one of the active trend traders. Welcome to this session of Market Tech Tips. We're doing something new. We're experimenting with utilizing YouTube Live to get some of these how-to tech tips up and operational in your hands as quickly as possible. I haven't got a clue how well this is going to work. However, and so Murphy's Law may definitely appear or maybe definitely apply. Well, let's dig into what I want to cover this evening. We're going to keep it short and sweet, and so we're going to move fast and furious. Hang on, the party's about to start. So again, today's tech tip is key signs of a top. We both all know that the market has just been absolutely getting whacked to the downside over the last little bit. And as you can see, is this a top? Was this really a top, or are we going to basically push down more to the downside? Who knows? We will know typically after it tops. But there are some clues and some keys and some that as to what we can anticipate and what a top looks like. And that's what we want to cover today. All materials are presented for training purposes only. Traders should always pay for trading a new method prior to the risk of their own personal capital. We'll ask you one simple, very simple thing. If you see this video and you are not a subscriber to the Market Tech Talk, our YouTube channel, please just subscribe and recommend it to somebody else. We put out some really good technical analysis tips, and this is one of those. First, as we push on towards, we just made newer highs in the indexes on the S&P, the Dow, and the NASDAQ. The Russell was basically kind of the redheaded stepchild, has been left out of this, a lot of this rally so far this year. We want to have an idea specifically of, in reality, how much, when we go into a bear market, what does a bear market really tend to look at? And this is a really good chart that shows that. It basically goes back to 1929 and tracks all the bear markets since then. We see here that the average bear market, a bull market, lasts about 9 years. And so the current bull market we are in, which is this one over here, has lasted more than 9 years. Now, a lot of people say that, oh, okay, it's gone over 10 years, therefore we've got to be topping and falling out of the sky pretty soon. Well, that's not necessarily the case. Why? If you look here at these other bull markets, this one here at 13 years, 15 years, 12 years. In our research, what it showed was that while the average bull market may in fact be 9 years approximately, if a bull market actually gets past 7 years, it tends to run for about 12, 13, plus years. And so if that's the case, if our past bear bull market started in 2009. We're in 2019 currently. That's 10 years into this current bull. One can extrapolate and say, there is a potential for this bull market to continue to push upward for another 2 to 3 years. Will it do that? Who knows? I mean, the market's going to do what the market wants to do. That's one of the rules that we understand with trading. So one of the things to be, as we're looking at potential tops, you want to be aware of, don't anticipate, participate. Learn what that means. So what we want to be looking at, topping tends to be a process. Each one of these topping patterns, well, it looks like it fell directly out of the sky. This is a timing chart, not necessarily what the actual chart of the index look like. Topping tends to be a process. We've been in a process over the probably about the last 4 or 5 months where it looks as if the market may be, getting a little bit toppy, ready to roll over. Secondly, bottoming tends to be an event. The bottom tends to be a lot more V-type bottoms, or it'll come down, hit a low, and then reverse back up, and then continue to move up from there. Some of the signs of a potential topping action is higher highs with waning momentum. What does that mean? It means our momentum is negatively divergent as we're making new highs. 2, increasing volatility. We're seeing a lot of that here over the last few weeks. Failed rally back to the previous high. We have not seen that yet, but we're going to be looking for that. And the age of the red, of course. We are at, while we're at the average, 9, 10 years for a bull market. So we have to at least take that into consideration that the bull market may be tired. It's running into the latter part of when you would expect a bull market to run. So that's one of the things to remember. Secondly is, again, don't anticipate, participate, good, partly good. Don't sell a new higher high unless, and I'm going to go over some of the reasons what you would do here, but this is a great chart for showing a couple of things. One, just basically a complete psychology of a market cycle. One of the things I want to highlight to you is if we have just had this and on up to here, drop back, and I would tie this back to about October of last year, maybe, and also especially in the Russell, and we just had this a little bit upper, get up to this there. In the Dow, the Nasdaq and the S&P got up a little bit higher, but we just had that move. And could we anticipate things dropping from there? Sure. Does that mean it's going to happen? No, but at least we'll be aware of the potential of something like that happening. So that's kind of cool. So this goes through some of the emotions, like when you get up here to the top, it's, everybody's euphoric going, this market's going to go, to the moon. And that's when some people actually buy, and then they have buyer's remorse, and just because oftentimes the people who buy here don't sell until maybe down here. They don't sell here. Right here, they're saying their prayers, saying if it'll just get back to break even, I'll get out. It doesn't. A lot of the people in the market they're very complacent, saying, well, the pullbacks have all worked before, but it will continue to fall from there. And then move on down, and then you start building it back up into, from being totally depressed, and that's when the market tends to say, okay, time to turn around. So don't sell the new higher highs unless, one, prices at past resistance are dropping, and or we have a candlestick reversal pattern. That is basically one of the reasons why we'd sell high. Negative divergence on the indicator. That could be also a great reason to sell a high. It is better, okay, these were the goods. The better is to wait for price action to prove itself. We were looking for constructive price action. I'm going to show you what that looks like on a chart. And lastly, the rally attempt failures. Rally attempt failures. And this is, when I say better, these are the premium type setups. This one can be a lot like when you're trying to pick the high. It's a lot like trying to pick the bottom, or or pick your bottom. You never want to do it in public. No, that's something else. No, it's like, it is a lot like trying to pick a high, pick a bottom. That is a losing game. So the big deal about this is be practice, be patient, and have discipline. One of the things, if you want to find more information about, I want to provide, good information for everybody. You want to find more information about the characteristics of the top, go here. There's a website there, investopedia.com, articles, /trading/10/signs of a market top, period, ASP. So that's a good thing to go. So let's take a look at what can we learn from taking a look at history. Well, one thing in history, we had a buildup back in 1929. Isn't it interesting that these same charts, this is the S&P on a weekly basis. Isn't it very interesting that almost 90 years ago, we're getting the same type of pull back to the mean, extend, pull back to the moving average, extend, pull back to the moving average, extend. You would think that, human nature would have changed over the last 100 years. Guess what? It hasn't. In fact, human nature really hasn't changed since Adam and Eve. Pull back, that extended rally. Remember that one chart? Then we get the blow off. And here is the area where I'm talking about. We get 820 crossover on the moving averages. That is, and we get prices violating to the downside and closing below, and we get a push up down to the other side. You get a slight relief rally. There's two of them here to pay attention to. One is this short-lived 1 week relief rally that pushes prices back up above the 8-period moving average. This is the 8-week moving average, approximately the 50-day moving average, if you're keeping count. And then it falls from there. I mean, this was a significant big drop. The move back, this relief rally here, was actually almost a 100% relief rally. I think it actually turned out to be about 87%. Fails. And then it goes through the same iteration again. Drops the moving averages, pops up, 820 cross. Those are that failed rally attempt. And then falls, failed rally attempt, and then really hits it to the downside. Look at the other clues that were showing up here. Negative divergence. This negative divergence was showing up real early in the game. Sometimes leading up to the major high, you'll get these minor highs where the momentum says, I'm not playing anymore. We get the major highs up here, momentum is rolled over. Let's take a look at 1929, 1937, 1938. Really beautiful pattern, moves back down below the 8-period moving average, retest it. Now this is the first rally attempt, pulls back down, then a healthy rally attempt. And what this rally attempt is from right here is trying to get back to these past old highs. It fails, and from there it's just, see you later, hasta la vista, baby, drops back down. And then what this nice thing about 1937, 1938, it shows the rebound coming back the same way. Look at positive divergence. And so one can basically take some of the same characteristics that you would apply to a upside reversal and apply them to a downside reversal, and they both apply, are applicable. It's just reversing your thought process or what you're looking at. But a big one is just watching for that momentum where it's starting to fail. So that was 1937, 1938, 1987. Again, you should be starting to see a pattern. Are they exactly the same? No, they are not. But not. Let me change colors on that so you can see it just a bit better. There we go. So we get initial drop. Rally attempt over a couple of weeks. Fail. And this is a big fail. All the way down here. Then you start getting your rally pops. This rally here actually went on to become a strong uptrend. But it's this move up here. These are the moves. This move up here is what you want to be looking for. Sometimes you'll get a second chance and sometimes even a third chance. But when you start getting down to the third opportunity to the downside break, that's when you can anticipate that that may be short-lived. And so you want to keep your stops really in tight and really close. Next, 2000. 2000 was a very good year. I talk about 2000 and the dot-com bubble. How did they know it was going to, the bubble was going to burst? Well, you just look at the chart. The charts are telling you we got negative divergence. We get a move higher. 1, 2, 3, triple top, pull down, and again, Look familiar? We fail, we drop the 8, the 20, and on a weekly chart, the 20-period moving average equates to the 100. Pull back up into the moving averages, and then drop. What's interesting is if you are a Fibonacci person, if you'll start calculating this, this is about anyway from about a 30% to a 60% rebound. So if you want to start planning trades, that's the way you can do that. And then this extension here, down to the downside here, is oftentimes equivalent to or symmetric to this move down here. We've been covering that a lot for our premium members. It's phenomenal how well it works. So 2000 worked in 2000. What about 2008, 2007, 2008? Again, see the similarity? Similar types, definitely similar. Up, down, up, down. Looks a little bit like a head and shoulders, huh? So negative divergence, corresponding here. Failed rally attempt, staying below the lows. It couldn't make it back up to the top. Reminds me a little bit when I used to fly, when I was flying in the Navy, we would do stall practice, and you would point your airplane straight up to the air, straight up into the sky, and you'd get up here and you'd stall out, and then the momentum would roll your nose over, and you'd start falling from the sky, and when you get up to a certain velocity, you would then pull the nose back up, and you could never make it back up to that same old high unless you added momentum, or in that case, jet fuel, to pull you back up to that past high. Because momentum just, if you're not adding more momentum, it just don't work that way. So that's what we have for our session. I want to pop over to the chart of the S&P to let us take a look at what exactly is in fact going on right as we speak. I want to take a look at a couple of different things. First, let's take a look at the, the monthly chart. Again, this is the first trade day. No, it's not the first trade day. It's about the third trade day of the month of August. Ugly. Okay, on a monthly chart. Had a little bit of a shooting star on last month, the month of July. Remember that. Could we suffer a significant downside drop during the month of August and September? We sure could. Why is that? It's because the August and September in particular, tends to be the weakest performing month of all the other months of the year. So anticipate more downside with that. A couple of things I want you to be aware of, though. So here's the S&P. We just had a nice sell-off on the weekly chart. We basically what happened. Here's what happened. Big selling last part of last week. All of a sudden, we have a lot of people who have bought stocks on margin, and all of a sudden the margin calls come in over the weekend. And so we call this margin call Monday. And pow, it happened. And the margin calls come in. So how do people typically cover their margin calls? They sell the stocks in their portfolio. Bingo, bango, rolls over, starts hammering to the downside. What else do we have contributing to that? Putting gas on the fire. Well, of course, the Chinese devaluing the yuan. And so it's just, it's kind of ugly. But the cool thing about it is, though, is we know it's going to be setting us up for something really nice going forward. So we have a move down, move up, move down. One thing we want to be aware of is that it is at a level where we could get a bounce. Let's throw a real quick fib on this. We'll just throw a real quick Fibonacci on this to get an idea of, I'm going to go to this high. I'm going to go to this high. No, the other high. This high. Come to this low. Back up to this high. And as you can see, the price over action over the last 2 weeks now, again, this is just Monday, has almost met the symmetry from the last move down in the April timeframe, or this is a pretty good flush. Now, if we do get down to 100%, amount of the flush, anticipate a bounce of about 30 to 38% back up into the moving averages, where we're going to anticipate maybe, again, study what happened over here in, when was this? October last year, where we get the flush all the way down below the, this is in this case, the 40-period moving average. Then we get a rebound attempt and then a larger flush down to the downside. Could this happen before the end of the year? Sure. I won't say the power that may want that to happen, but it sure could happen. So let's take a real quick look. I just want to take one last look over at the daily weekly, which you see right here. What do we have going on if we compare it to the other charts? This is the 50-day moving average, is the gold line, the purple and the bluish line are the 8 and the 20. This is the 8, the darker line. The 20 is the skinny line in the middle. What do we have? 820 cross. That's a bearish cross. Price action on Friday closes below the 50-day moving average. Not good. Then here's where the big dump came in. Fell from the sky. Now, the extension that it could get to, now it may stop right here, short of this 100% retracement, it might. However, it could also come on down here, touch the 100, but also get all the way down here to the 127 extension. And it tends to be that you will get a reversal at these extension lines. And you can see this 1272 is, guess where? Almost at the past high. So what am I looking for? Now, if we blow on down here to this level here, I will look for a reversal signal back to the upside, at least to trade it back up to the moving averages. That's to be a reversal to the mean. However, a preferred method would be to trade it if price action rolls back up into the moving averages. That's where I would look to take a short trade. So it would look something like, this. Let's say I get a pullback here. Let's say I get to the 100%. Then by that time, these 820 will be about down to there, approximately. I would expect a bounce back up into that area, let's say the 2900 area, and then a move back down from there of approximately equivalent distance to this amount right here. But right now, I don't have the positions in place to say that's what's going to happen. So, okay, that concludes us for today. I wanted to get this tech tip in your hand, also a little bit of market analysis, so you'll be basically aware of what to be looking for going into the rest of this week. I'm just keeping my powder dry. I know what I'm looking for. Is I want a full blow off down into these areas down here, or I want to rebound back up into these areas here. Those are my two areas of our zones of demarcation where I'll be making my trade decision at those areas. So with that, I bid you adieu. God bless everybody. Let me know, again, if this is a good format. Please leave a comment saying it is. Give me a thumbs up. Appreciate that. And share this with your friends, family, and if you're seeing this video somewhere else out there in the world, the internet, become a subscriber, and you'll get updates to when we actually do our free webinar on Friday, where we highlight exactly what we're trading the week before. So until later, God bless everybody.